Good day. My name is Hardus van Pletsen. I'm the managing director of a company called Stock Market College. My cell phone number is 082 908 3332 should you need to phone and get hold of me. Alternatively, you can email me, perhaps a better idea, on hardus@stockmarketcollege.co.za. What am I doing today? I'm still talking about the Streetwise investor. Today I'm going to do what I like to call Chapter 3, and we are going to talk about shares versus unit trust. Why are shares or buying shares a better deal than going for unit trusts? Okay, I've got a little block here. It says unit trusts. What are the advantages? Let me expand on that. Firstly, with unit trusts, it's possible to get a better return than endowment policies and retirement annuities. I think the second advantage, which I think is a lot more important, is that you don't have the same liquidity problems. Now the question would be, what do I mean by liquidity problems? Firstly, you can sell your unit trust at any time if you need your money. If you need to get out of your endowment policies, it's going to be a tad more difficult and cause quite a problem. I think the other thing that I wanted to mention here is with unit trusts, you can sell a portion of your unit trust. You don't necessarily have to sell all of it if you need some money. All right, let's go here to unit trusts. What are the drawbacks? Great. Higher costs. I've got to expand a bit and talk to you about the higher costs. Firstly, when you trade the stock market, you're going to pay your stockbroker a fee, you're going to pay marketable securities tax, you're going to pay a handling fee, and perhaps your average cost will amount to around 3%. Now it's very important to know that you will only make money from any investment once you've covered the costs of entering into that investment. So what I'm trying to say here is, with the stock market, you've got to buy shares and make at least 3% profit on your money before you can say that if you sell, you'll make a profit. With unit trusts, there are two costs that you incur. Firstly, it's the cost of trading the shares on the stock market, these shares that form part of these units. And then secondly, the unit trust company will also charge you their fee. And therefore, as you can see in this example here, typically buying unit trust will cost you around 6%. It's double the amount of fees that you pay if you buy shares directly. So that means that your shares have to, correction there, that your unit trusts will have to grow a hell of a lot better before you start making money. Okay, so I always ask people and I say to them, why do you buy unit trusts? And they come back with 4 reasons. They say to me, Hardus, I'm going to do it because I'm going to get the expertise of management. It gives me security. Man, I can diversify my portfolio. And I think another thing they mention, it's a no-brainer. I'm going to talk about these 4 things one by one. We're going to start with management. I'm going to expand this here. And I've made some notes and said, team of experts judge results against the benchmark, JSE overall index, and which one to buy. Okay, here goes. Story. Firstly, most people believe that managers of unit trusts will manage their money more effectively and more profitably than they themselves could. If you're completely ignorant of the share market, this is an easy conclusion to draw. And the unit trust advertise that they have a team of experts who manage the fund with the best information available. But do they really offer a superior return? The only way to judge this is on results, against some kind of benchmark. What would the benchmark be? A person who was completely ignorant of the stock market would be forced to choose his or her shares at random. So let us suppose for a moment that you limited your share purchases to the shares which make up the JSE overall index, and that you choose your shares completely at random. Then you would expect to perform roughly in line with the overall index over a period of time. This must be true because the overall index is an average. It's actually actuarially weighted of the shares from which you would be selecting. Now, you would certainly expect a team of professional managers to outperform such a purely random selection. The JSE Overall Index therefore make a good benchmark against which to measure the performance of general equity unit trusts. There would obviously be no point in paying 3% of your hard-earned after-tax savings to an organization which could not at least keep pace with the overall index. After all, in theory, the chimpanzee from the local zoo could do better. It is then sobering to realize that according to the Unit Trust Survey for the quarter ended 30th September 2004, published by the University of Pretoria, shows that over the previous 7 years, over the previous year, only 7 out of the 42 general equity funds managed to beat the JSE All Share Index. In other words, more than 4 out of 5 of these unit trusts could not beat the index. So that also leaves us with a problem of which unit trust to buy. These days there are more unit trusts to invest in than there are shares on the stock market. I always look at this and say, man, if these guys manage your money and they can't beat the index, why pay them? Alright, let's go to the reason of security. Firstly, people perceive unit trusts to be more secure. They think it's more secure than buying directly into the JSE. After all, these unit trusts are managed by large financial institutions with well-known names like Old Mutual, Standard Bank and others. Surely your investments are safe with these people. Well, let me say, if you look at a unit trust chart and you look at the chart of some of these insurance companies, they follow really the same trend. If you didn't really know which chart was which, you would think I'm trying to show you two of the same charts. Why can they not do so well? Firstly, they have too much money to invest. Every single month there are people like you and me, and I think better English should be you and I, and we have this debit order running off our account and all this money goes to the institution. They take this money and they buy a basket of shares, call it in units and dish it out to us in relation to the money that we've invested. What it really practically means is that they can't always buy at the bottom of the cycle and they can't sell at the top of the cycle because they just own too many shares. It brings it back to liquidity. They have maybe better software than me and you have. They make it their job. They do it all day long. But even if they knew they were at the top of the cycle, it's just not possible for them to sell there. And that's where we as the small private investor have the advantage. Okay, let me move on to diversification. A lot of people come to me and they say, Hardis, if I buy some unit trusts, I can get expensive, better quality shares. I don't have to fool around with the penny stocks. I can go and get some blue chips. I always say to my clients, if you've got a small amount to invest, you're not going to carry that much risk. It's not as if it's your life savings that's staked on all of this. Your risk will increase as your portfolio size increases. But I want to come back to the small amount to invest and why I think it's not always great as a beginner on the stock market to diversify. If you buy some penny stock shares at R1 a share and these shares move to R2 a share, you've just made 100% on your investment. If you go and buy some blue chip shares like Sasol, trading let's say around about 350 Rand a share, those shares have to go to 700 Rand a share for you to make 100% on your money. What is the chance of that happening? Number one. And number two, how long will it take for the share price to go from 350 Rand to 700 compared to a penny stock where the share can go from 50 cents to R1 in a relatively small period of time. Alright, last but not the least, let's talk a bit about the no-brainer story. I'm going to expand it here. A no-brainer. Man, I love this software where I can fit my map in and I can show you guys exactly how it works. A no-brainer is a term that I use for something that requires no thought. You don't have to do anything. Now that's what you do when you buy a unit trust. You don't have to think. You have this debit order, comes off your account, the money goes to institutions. What you're in essence doing is you're paying someone to think for you. Now when you pay someone to think for you, from hard experience, I can tell you that it's never worked out well for me personally. But the question that I always like to ask is, who cares more about your money? You or someone else? Who's the person who's going to retire one day? Who's the person who have children that they want to give the very best that they can? Who's the person who want to travel the world? Who's the person who deserves to get a decent return on their money and have control over their future? Well, let me summarize it today. Stock Market College, there's our website. That's what we do. We're going to teach you about the stock market with our profit course. We're going to give you the Quick Charts professional software so that you can have the tools. We're going to give you our download service so that you keep abreast of all the information. We're going to work with you to open a trading account so that you can trade and get going for your own account. We'll obviously help you with Arzell Financial Services to do a financial needs analysis and see where you are. Then the next step would be is to involve you in our business opportunities, and last but not the least, in our investment clubs. Now what I'm going to do is I'm going to send a very short survey tomorrow, maybe 2 or 3 questions, just to get your feeling about unit trusts and get an idea of where your investments are. Once again, it was great fun making this video, and I hope that today I've taught you something new. Goodbye.